Today's financial advice is sponsored by Endeavor Private Wealth. Well, Chris McGee, managing partner at Endeavor Private Wealth, is joining us for our segment on investing. Chris, good morning. Glad to have you back.
Thank you. Good morning.
So, Chris, I understand that there are more registered investment funds than publicly traded stocks on the U.S. stock exchanges. With more than 10,000 funds for investors to choose from, how do they go about distinguishing one fund from another?
Investors generally have four types of mutual funds to consider: equity funds, bond funds, short-term debt or money market mutual funds, and then hybrid funds, which are comprised of stocks and bonds both. Funds can be characterized by market capitalization, such as large cap, mid cap, small cap, or by sectors such as industry, which would include technology, healthcare, consumer staples, just to name a few, by investment styles such as growth or value, by geography, which may include domestic, international, global, and emerging markets, and by strategy, such as ESG funds with specific environmental, social, and governance investment themes.
And so what's the first thing that investors usually think of when considering these investment choices?
Well, I can't speak for all investors, but one of the first things people consider is the fund's name. And very recently, the Securities Exchange Commission adopted a new rule pursuant to the Investment Company Act called the Names Rule to help ensure that a fund's underlying investment portfolio matches the fund's name. It's essentially a truth in advertising rule to promote the integrity on behalf of the investors so that the fund's investment portfolio is consistent with its advertised investment focus.
So what precipitated this action by the SEC?
Well, let's say a fund includes its investment strategy in its name. Suppose there's a XYZ green energy fund, for example. That name may attract investors who are interested in supporting ESG investment principles. The name rule requires that the fund invest at least 80% of the value of its assets consistent with its name. So in this case, at least 80% of Green Energy Fund should be invested in companies who promote sustainable, environmentally friendly, renewable energy. The fund would be violating that rule if more than 20% was invested in coal mines, oil and gas companies, plastic manufacturers, or other types who have little ESG merit.
And is that what's referred to as greenwashing?
It is, yes. Greenwashing is an unsavory practice at best or a deceptive practice at worst, whereby companies claim to be environmentally friendly but actually aren't, or they may be exaggerating the extent of their commitment in order to gain investor and shareholder favor to improve their public image.
And how else might the rule apply?
Well, suppose XYZ also offers a large cap growth fund. If the fund actually owned more than 20% in small cap value-oriented companies, it would run afoul of the rule.
And Chris, we're running a little short on time. Any final thoughts on this subject?
Yeah, the name rule is really a very simple and fair idea. Say what you mean and mean what you say. If a fund's name implies that it's focused on a particular type of investment, the fund should mean what it says and make investments consistent with its name. It should also explain the meaning of the language it uses so that there is no ambiguity or confusion. But a fund's name is just a starting point. A former chairman of the SEC once said, "An informed investor should look beyond the packaging of the fund and also see what's inside." Investors should carefully read and review a fund's prospectus, statement of additional information, and other required disclosures before investing. And you can also benefit by discussing your investment with a trusted financial professional.
Well, Chris, thank you for bringing this interesting development to our attention. We always appreciate your time. And of course, everybody, to learn more about Endeavor Private Wealth, visit endeavorpw.com.